All right, let's talk about Henry Schein's second quarter. On the surface, the numbers looked like a total mess, and the market, well, the market did not like it one bit. But if you peel back the layers just a little, you start to see a company that's right in the middle of a huge strategic shift. So the real question is, are we just looking at some short-term pain, or is this the foundation for some serious long-term gain? And when I say the market didn't like it, I mean it. The reaction was fast, and it was fierce. The stock got hammered, dropping 8% right after the earnings came out, and on massive volume too. This wasn't some little dip. This was a classic get me out now reaction from investors. So that's what we're going to unpack here. What exactly sent investors running for the hills? And maybe more importantly, is this a real red flag for the company? Or is management's turnaround plan solid enough to make this big sell-off a golden opportunity? Let's find out. Okay. First things first, let's look at the actual headline numbers that caused all the drama. This is where things get a little weird, a little confusing, and it really sets the stage for the whole story this quarter. Now check this out, because this is the disconnect that caught everyone off guard. Revenue? It actually beat what the analysts were expecting, coming in at $3.24 billion. So far, so good, right? But the bottom line, the profits, told a completely different story. Earnings per share missed by a lot. The takeaway is simple. They sold more stuff, but they made less money. And that's a combination that just screams trouble on Wall Street. So the big question is, where did all that profit go? Well, the answer is hiding in the company's biggest, most important business, their U.S. distribution arm, which got squeezed and squeezed hard this quarter. Management basically pointed the finger at two main culprits. First, you had really intense competition that drove down the price of gloves, which is a huge product for them. And second, they ran what they called time-limited targeted sales initiatives. That's really just a fancy way of saying they were running some aggressive promotions to win back customers they might have lost after a cyber incident about a year and a half ago. So it worked to get sales up, but it came at a big cost to their profit margins. And here is that cost, all boiled down into one painful number. The company's non-GAAP operating margin fell by 79 basis points. That's almost 0.8% compared to last year. Now, that might not sound like a huge number, but in this kind of business, that is a significant drop, and it's the direct reason for that big earnings miss we just saw. But here's the thing. Management isn't just standing around watching their margins get crushed. Nope. They've laid out a really clear multi-year playbook designed to get profitability right back on track. Let's break down what they're planning to do. So their plan really has three core parts. First, a good old-fashioned restructuring to slash costs. Second, they've launched a major new partnership with the private equity giant KKR and its operations team Capstone to find new ways to be more efficient. And third, they're doubling down on their long-term strategy called Bold+1, which is all about shifting their business toward higher margin products and services. And that restructuring part alone is a really big deal. Sure, the company took a $23 million charge for it in the second quarter, but get this, they're now expecting it to deliver over $100 million in annual savings by the end of 2025. That is a massive tailwind for their future earnings. And I think this quote from the CEO, Stanley Bergman, is so important. He's making it clear that this turnaround isn't just about cutting costs or jacking up prices. It's about finding smarter ways to deliver value to their customers, which in turn will help their own bottom line. It's really about working smarter, not just being more expensive. Now, while that big distribution business was struggling, it is absolutely crucial to see what's happening in other parts of Henry Schein, because some parts of the business are performing incredibly well, and these are the engines that management is really betting the future on. And you can see the difference clear as day right here. The technology and the specialty products parts of the business are growing way faster than the core distribution business. That tech segment especially, growing at a super healthy 6.6%. And here's the kicker. These are the company's higher margin businesses. This is where they make the real money. And this right here, this is the whole end game. This is what that Bold+1 strategy is all about. Right now, these fast-growing, high-profit businesses make up 45% of the company's operating income. Their stated goal? Get that number over 50%. They are so close to a huge inflection point, where the majority of their profit is actually coming from these newer, more attractive parts of the company. So when we put all of these pieces together, you've got the margin pressure on one side, the turnaround plan on the other, and these high-growth engines chugging along, what does it all mean for the stock?
let's get to our final analysis and our rating. Okay, first you have to understand their guidance. Management kept their forecast for the full year the same, but they made a point to say that earnings would be heavily H2 weighted. All that means is that the second half of the year is going to have to be much, much stronger than the first half was. They're basically asking investors to be patient, telling us that this turnaround is going to take a couple of quarters to really show up in the numbers.
So, what are the key signposts we should be watching for over the next few months? Well, I'm watching for 4 crucial things. We need to see real, tangible progress from those KKR initiatives. We need to see them selling more of their own higher margin private label products. We need to see a rebound in equipment sales. And finally, we need a concrete update on that $100 million savings plan.
And this slide really captures the battle that's happening with the stock right now. You've got the market, which is totally focused on the negatives from this quarter, the squeezed margins, the earnings miss. But then you have management, who's telling a completely different story about the long-term positives. Huge cost savings, a powerful new partner in KKR, and a strategic shift to a much more profitable business model. So, with all that in mind, our rating is market perform. Look, the negative reaction from the market was understandable. The near-term pressure is real, and there's always a risk they won't execute perfectly. However, management has laid out a really credible, multi-part plan with clear things to watch for. We think the risk and the potential reward are pretty balanced right here, at least until we see some hard proof that the turnaround is really working.
And this all leads to the final and maybe the most exciting thought here. If Henry Schein can actually pull this off, if they can successfully pivot so that more than half of their profits come from high-growth software and specialty products, will the market stop valuing it like a boring, low-multiple distributor and start seeing it as a higher-multiple healthcare technology company? Because that potential re-rating, well, that's the whole long-term bull case right there.
And of course, just a reminder, this is not financial advice. It's our analysis to help you understand all the dynamics at play.